Rook side, we look to be just pulling our stable coins coming up here soon. And so this gives us another opportunity to just understand different protocols, different options a little bit more, where we can kind of park our money a little bit to get additional yield. I guess a little housekeeping before we kind of get rolling. We will not be going into the initiative section of Treasury Tuesday today, as we'll be kind of focusing, I'd say maybe around 45 minutes on this kind of panel. But maybe we'll kick things off with some quick intros and hearing a little bit about each protocol. So, Gabor, do you want to kind of kick things off and tell us a little bit about what you do at Maple Finance and what you guys do as a protocol?
Yeah, maybe Sid starts. He just raised his hand in time. So he can maybe start with the intro on Maple, and then I can join from the Maven 11 side, being a pool delegate.
Sounds good. Hey, Sid.
Hey, guys. I just saw there's a really old picture of me. Maple's an institutional lending platform. So it's falls into the DeFi lending space. Think of it like the creation of pools which people deposit into. Each pool has a manager, and that manager is approving loans to institutional borrowers. So it's mostly serving market makers, market neutral funds at the moment, but generally crypto native firms. And it's been live for about a bit over 12 months, and it's at about 1.5 billion in loans to date. And then we've got Gabor here, who is from the Maven 11 team. And so Maven is one of the delegates who are managing the pool, which means going out, sourcing deposits, speaking to borrowers, reviewing their financials, approving and negotiating loan terms with them, and then ultimately servicing that book, which means, staying in contact with them each month to make sure that they continue to repay their loans.
Yeah, exactly. So just a very brief intro from my side as well. As I mentioned, so I work on behalf of the Maven 11 team in the capacity of a pool delegate. So we're sort of the asset manager, like the BlackRock on the DeFi rails of Maple. We run two pools, one USDC pool, one Wrapped ETH pool. Keeper is a depositor in the USDC pool. This is one of the topics of discussion today, and we have came on the calls from time to time. As you remember, we have had an extensive AMA, but then also tried to jump in here just from time to time, just lurking in to hear what is important to your treasury and to your protocol as such. And very happy to be here and give the perspective. Having been through the storm now with the whole team, we have 5 people working full time on this, and basically since 11th, we have been more or less, it doesn't sound healthy, but we have been working on this more or less 24/7, also together with the Maple team, and have tried to, be as close to all stakeholders and mainly the borrowers to be able to monitor the counterparty and default risk.
Awesome, and thanks for that. And yeah, we definitely have about $3.5 million deposited with you guys currently. And yeah, to your point, you guys have always been pretty active here and have always been willing to come in and kind of talk. So I appreciate that. But I guess turning attention to Teddy with Notional Finance. Hey, Teddy, you want to kind of kick things off and tell us a little bit about what you guys do over there?
Yeah, sure thing. So first of all, thanks for having me here. So I'm the co-founder and CEO of Notional, and Notional is a fixed rate lending and borrowing protocol on Ethereum, and we've been live for about 7 months. Notional V2, and we currently have about $175 million in TVL, and just recently surpassed $500 million in total loan volume. So Notional is an over collateralized lending protocol. So we allow people to borrow and lend at fixed rates against Ether and wrapped Bitcoin collateral. We sort of serve a broad range of people. So there's some of our borrowers are more on the retail side, and then we also have some more institutional borrowers as well. Over the past week, I've sort of been thinking about, I think that the past sort of the market tumult and all this stuff that's happened in the past week or two has just really been in my opinion, a validation of what we're building in DeFi, not just Notional, but kind of all of us here, and just like showing the strength of, infrastructure that is transparent. So Notional ourselves, we've processed, a fair number of liquidations in the past few weeks, and there's we've had no insolvencies on the platform, no funds really at risk the entire time. We're actually working on, we're going to publish a little retrospective of how everything went, and I think what's something that's really cool about DeFi is again that all of the sort of positions of Notional's users are fully public for anyone to see. And so, when we publish this retrospective, you're going to be able to see exactly what happened and know that you have all the information, which is, I think, something that's very unique. And you just look in contrast to, the centralized crypto lenders, it couldn't be more different, right? I think that, probably a lot of us feel like that we're kind of on the outside here. You can sort of know over the last few weeks that something's going down, right? That there's these insolvencies, there's all this trouble, but I think, I personally, and I'll bet probably some of the others on the call as well, had this sense that, well, there's all this stuff kind of going on in back rooms, right? Where they're kind of cutting deals as to who's going to pay what and ultimately who's going to take these losses. And that's all completely obscured from public view. And everybody else is just sort of left totally in the dark with their assets frozen, and it's just not great. And you contrast that with DeFi, where everything is completely, transparent for everyone to see. And I think, the past few weeks, just a great demonstration of why what we're building is important.
I can only second that what Teddy said. The transparency is one of the key issues. No one knew what certain counterparties have on their balance. It's a lot in the dark, hidden in huge balance sheets. I mean, the companies that have struggled, balance sheets are massive, and no one or very limited people know exactly what is in there. So even if you are comfortable with having your crypto on Celsius, Nexo, BlockFi, etc., it's very hard to know what happens exactly in the background. Whereas that is one of the big strengths of DeFi, that whether it's Notional, whether it's Aave or Maple, you see exactly what's happening with the funds. And this is a very clear instance here for Maple, where you can see the pool, you can see exactly which counterparty is in it, and what you can track the news on Twitter and what have you. Whether a company may be in a very strong position, like market makers, for instance, they have done all very well, and it's a complete different level of auditability that DeFi provides. So that's very bullish for the entire space.
Yeah, without a doubt. I think externally, people outside the space, they see what's happening, they hear the high level and of the situations, firms, funds blowing up, and most of them are all centralized entities, but they relate it to DeFi, and it's complete opposite. So that's what we're here to combat. But I definitely want to dive into a little bit more, but definitely want to give Windra a little bit of a chance to introduce himself and Element Finance. Hey, Windra, you want to go ahead and do the quick intro as well?
Yeah, thanks for having me here. It's great to join this community and see what you guys are up to. I am Windra. I am part of the founding team at Element, and I currently lead growth and strategy. Element is a fixed income issuance and marketplace. We pretty much wrap external yield sources that are currently existing in DeFi, and we turn them into fixed rate income type of products that users can buy and earn a fixed rate out of. And, we've been live on mainnet since the middle of last year, and we're currently entering our V2 audits, soon to be announced in the next month or so. So far, traction has been really good, and most of our users actually are, I would say, on the conservative side of asset deployment, especially in regards to crypto and DeFi. I would say we have a lot of DAOs that use our protocol. We have a lot of institutions or just conservative family offices that are currently trying to explore the space. as well as some, revenue generating companies that are specialized in crypto. They also use us for more of like an asset management, treasury management solution. And yeah, just happy to kind of go into that a little bit more. Yeah, definitely the last 2 weeks have been kind of crazy. As you can see, a lot of the top tier DeFi protocols have not really faced any issues. However, all the centralized entities such as the Babel Finances of the world, Celsius, BlockFi, the ones that are kind of covered in a black box, those are the ones that have issues, and users that have funds in those specific platforms are the ones that are a little bit wary at the moment. So I do think that the past month or so has been a pretty big bull case for DeFi in general. I think Teddy and Sid has mentioned transparency, and I agree 100%. I think DeFi, these type of instances, is what I think creates a lot of adoption and growth and awareness for the necessity of DeFi in general. And like I said, just excited to be here and talk about some of the conversations I've been having with users and institutions and DAOs in general. In the past month, I know people are a little bit scared at the moment, but I think having this conversation definitely helps.
Yeah, I think you guys all hit on a really good point. I'm always going back to like what the rest of the world, what's the rest of the total addressable market, at least how I see it, really think about the space. And, I think one thing that's really lacking is the lack of understanding about the full transparency that we have because of the power that is blockchain. Could you guys maybe, this is going to seem a little obvious, but could you guys just kind of talk a little bit about what do we need from an educational standpoint to really open up what is probably your total addressable market, and maybe talk a little bit about that, but just speak to what do we need to do from like a industry standpoint to help educate people, to show them that there is a greater power in the transparency, and that the protocols that you're building are truly like light years ahead of what TradFi is building and has built in the past. And anybody can kind of take that.
Yeah, sure.
Cool. Teddy, you go. You go. No, you go.
Okay, sure. I'll go first. I mean, I think from a growth and strategies perspective, in the past 2 weeks, we've kind of taken a much more educational approach, as you've said, when engaging in conversations with a lot of the users that are not so sophisticated with crypto and DeFi in general. What's really interesting is I think that the Terra Luna situation was a big red mark on the space in general, much bigger than we think, because from the outside looking in, UST and Terra in general was like this $40 billion stablecoin. That's exactly what people described it as. It's like a one-liner and it's a $40 billion stablecoin. And now, because it collapsed, the initial thought that everybody who isn't fully aware of how the mechanisms of everything, how it works, is that if a $40 billion stablecoin collapsed, any other stablecoin can collapse. So, we have started to really take a new approach in confidence building. We've just started back from zero, explaining to a lot of our users exactly why this stablecoin is different than that one, how DeFi works in general, why blockchain matters, transparency, and all those things. I think, because so much trust has been lost, we are currently setting ourselves up for the future. We're currently re-educating everybody so that one day, when they are fully aware of exactly how things work, when they are ready to make that jump, and when the market, recovers a little bit, I think the entire DeFi ecosystem is going to pick up a lot more users. So that's where we've kind of taken our approach in terms of growth at the moment. Not necessarily user acquisition right now, because everybody, like I said, everybody is scared, but mostly try to make sure everybody understands what exactly is happening in the space. Kind of take it month by month, week by week, so that, like I said, by the time everything starts to pick up in terms of confidence, these users are ready. They're ready to deploy capital. They're ready to use these protocols and test out, Notional and Element and Maple and so forth.
Yeah. So I want to also just add that, not everything is in your control. So I think some people will have seen what's gone on with Terra and just kind of like write off the space, right? And ultimately, like, for somebody to learn, they have to be receptive. There has to be some, it's not all one way. People need to be need to want to understand, so, and not everybody does. But I think, putting that aside, I think in general, like, you want to show and not tell, right? So I think that, like, we say words like transparency and decentralization, and like that's stuff that these are like words that you can say, but it's not clear what it actually means. And I think that it's really like, making the most out of like time periods like right now, right? Like what we've seen kind of in the last few weeks, because again, what we all said just a couple minutes ago, like how this was such like a great demonstration of the value prop for DeFi. I think it's really just like, it's trying to use real world examples like what has happened here and just hammer them home with sort of like proof. And that's why, like, why I mentioned earlier today, or like earlier in this call, that like, we are going to publish a full retrospective of like everything that happened on Notional and like every liquidation and like exactly how quickly the accounts got liquidated after they had become under collateralized, like a full explanation of how it worked. And just like, you can go back and you can look at the blockchain, right? Like you can see like, all right, within 15 seconds of the Oracle update that like caused this account to become under collateralized, there is a transaction submitted and that liquidated them, right? And like, I think it's like, and I think it's showing people like, and not just saying it's transparent, but like, what is it being transparent allow you to do that you can't do in CeFi? And I think it's that you can really like take people step by step through how the system works, and just really show it to them in a way that you can't do, with these CeFi lenders. And you have to hope that like people are receptive to understanding the difference, like that they want to understand, and then you just show it to them. Yeah.
Yeah, we have a lot of conversations with institutions through, and we have a director for institutional sales, so his job is to talk to them all day long. And actually, what Teddy just says, and we take it even further. So we are also working on education material, and we don't even show how things worked out, but even able to prove and provide evidence that it's even better than traditional finance. Like the New York Stock Exchange would have closed down. I mean, that's what happened in 2008. DeFi just continued working. Liquidations went smoothly, even though price action looks painful, but everything works perfectly. And it's actually extremely bullish. So in the short term, we are all suffering, I guess. But if the dust settles, we have a very strong storyline here. And I think many institutions or professional investors have waited for this kind of battle test. And if we manage to get through this storm well, I think this will be, in the medium or long term, a very, very strong story.
Yeah, I really like all your take on that. And, I think one thing that's missing from the conversation, I think a lot of us are probably aware of that, but, we talked about the craziness over the past couple of weeks, the strength of DeFi in these trying times. But, one thing maybe we should do is just kind of define what, from your perspective, what you think has happened. I think we've all seen on crypto Twitter and from our own perspective and rumors, but, if you guys were to kind of take a step back and look objectively about what and looking at it from a data-driven perspective, maybe other connections you have, or maybe even firsthand knowledge based off of what you're seeing in your own protocols. What exactly, obviously price has gone down and that called a cascading effect, but, would you guys like to talk a little bit more about the mechanics of the market and how maybe this has caused the major price catalyst downward we've seen? Do you want to kick that off if you have any insight?
Yeah, I mean, I think that, granted, as someone who isn't like inside, like exactly what's happened over the last few weeks, I mean, I think it's pretty clear. It's just been like, forced liquidations, right? So we saw, I think, we saw some of that in DeFi, right? So some of that on borrowing protocols like Notional or Compound or Aave. And I think that, there was a whole lot of it that we did not see. Because I think that, basically the liquidations weren't restricted to DeFi, right? And the big price down, move down was like, yes, part of it was liquidations in DeFi. And I think a lot of people like on Twitter and stuff focused on that just because like you can see it. But I'm sure that, there were really big trades going through, like related to the sort of CeFi lenders. I'm sure that's the case.
Anybody else have a take on any knowledge that they have or any thoughts on in their perspective?
Yeah, I mean, what you're seeing in the whole space, though, in terms of what's driving this kind of downward shift is, delevering of the system. So the cost of carrying debt was way lower before. Now the central bank is raising interest rates. It's sucking lending and leverage out of the system. And that makes its way first to crypto assets because it's a smaller market cap with less liquidity. So I think that's driven liquidity out of this as an asset class, and it's just reverberating through DeFi. I mean, it's occurring both in CeFi, where you saw a pullback in liquidity in lending platforms like Celsius, Celsius, BlockFi, Babel, and then that makes its way into the system because those players are big traders, both across the centralized and sort of decentralized protocol space.
Yeah, so that's actually interesting what happened on the CeFi side. So they have been a competitor to our pools basically since Maple launched, and obviously they have been around for a way longer time. But the funding is just a complete different source. So we have our funding on Maple from people who proactively opt into or decide to deploy capital to a certain asset class, being under collateralized loans to crypto native borrowers. Whereas on Celsius, I would say many customers or users are perhaps not fully aware. They just saw that there's a certain APY promise and perhaps didn't question where this comes from. And the capital base was growing over time, obviously with the bull market. And while we have no clear visibility or insight into how the loan book is or has been managed with Celsius and peers, it is clear that there was a mismatch in loan tenors. So they have only a very short-term funding because the deposits can be withdrawn or should be able to be withdrawn on short notice. And in the same time, the capital was deployed not in a way that it is equally liquid, i.e. Engaging in staking offerings or staking products or handing even out term debt. So this was also one of the reasons that has caused a liquidity crisis. And I think what we have seen is, and maybe someone was around in 2008, it sort of felt like exactly the same. It was a liquidity crisis where perhaps the company was not insolvent due to too many losses, but it was just illiquid. And once you're illiquid, you try to get the money from wherever you can, and then this has also been instrumental to initiate the liquidation cascades.
Yeah, I think it's probably important to note that, based on the headlines you've seen over the last few days, you're seeing the evolution of effectively an FTX put on the space, which is probably going to lead to more concentration among the centralized, or CeFi crypto providers, because it's going to depend on having backstop liquidity from FTX. Whereas I would say in DeFi, what we want to resist the urge to do and kind of do instead is to continue to build protocols that are self-sustaining and that continue to work as intended, without the need for this kind of backstop, like a backstop line of credit.
Yeah, I think that's like a really interesting point, right? Is that we've seen, FTX is basically from all accounts has essentially bailed out half of these CeFi lenders. And I'd actually be curious to know, and I don't know if there is a way to know, but like I'd be curious to know, like, has sufficient liquidity been provided, right, to the system to ease that liquidity crunch that we're sort of talking about here. And again, it's like it sucks, right? Is that like if you're on the outside, if you're like not Sam, Bankman-Fried himself or somebody that works really close to him, it's very, very difficult to know like the state of the sort of aggregate liquidity in the system, which, obviously just really sucks. And like, if this were all sort of transparent and done on chain, everyone would be able to know. But like, as it stands, we don't know if there are people that still need to sell their staked ETH or not. Right? We don't know if all that has kind of happened or not. So I don't know. I mean, I would love to know. But, again, it's just sort of a testament to how opaque, CeFi is and just, how it concentrates information asymmetries. Yeah.
Got it. And I really appreciate all the takes on that. And I promise I won't be focusing on all the FUD and headlines. I just figured it'd be good to kind of get that out of the way. But, kind of diving maybe one more aspect of FUD, keeping that theme going. I know we've talked about there being a liquidity crisis. We're kind of unsure about, how much still needs to be sold to kind of, ease this crisis. And I know there's been talks about, contagion risk. What do you guys think about? Are we still at a point where we can see a lot of contagion risks in the DeFi markets, in crypto at large? Gabor, you want to have your take first?
Yeah, I mean, the statement is perhaps more based on sentiment, but my gut feeling is that we have hopefully seen the most. I mean, there was a heavy and concentrated liquidation activity that was very well traceable on chain. We have seen the domino pieces falling one after the other, going through staked ETH, etc., etc. And it feels a bit, or at least there is no evidence that there is something next. And there was contagion starting with Luna that has led to holes in balance sheets. Then 3AC came around the corner, Celsius. And I think the backstopping from, I would say, the central bank of crypto, being FTX, probably can provide some comfort. The numbers are huge. It's actually pretty impressive that they, within this short time, are able to provide these backstop facilities, and that should be able to bring some calm to the space. We have since actually Luna started, been extremely close to our borrowers and have even intensified that since Celsius, basically having daily interaction and even physically met a couple of borrowers when there was an opportunity to do so. And we're also meeting some this week, very close. And there we see unchanged metrics. So given the business they operate in, it's not that they are. So it is a lending crisis, I would say. So there are different business models, and you probably need to watch all the lenders that are intertwined in the space. The ones in our pool being market makers, mainly some yield funds. And with the yield funds, then obviously the risk is that you have too much exposure to Anchor, which was the guaranteed 20% yield, as we all know, very much guaranteed, which we have not seen across pools on the Maple platform. And market makers, they actually benefit in the short term from price action and volatility. They have actually been rather complaining before all this has happened that the market is not volatile enough. And so on that end, I don't see contagion risk. But I think this will slowly uncover if there is a next one. But with the liquidations we saw on chain, and I hope that we have seen the not only the tip of the iceberg, but also how it all played out.
What's your take, Windra? Have we seen more than the tip of the iceberg? Have we seen the full thing?
I think we have, because a lot of the major platforms are salvaging their positions. I do think that there are going to be some short-term pains for some of the smaller players in the space. I know some smaller centralized exchanges, for example, did treasury management solutions with some of these funds. A few, aspiring lending apps out there that are based out of Southeast Asia who cater to that clientele. They have treasury management solutions with some of these big funds, and that's why some protocols that were just simply builders who received investments, they also lost some of their assets and capital. So from like the building side, from the protocol side, there is going to be some pain there. They're going to have to figure out how to source capital elsewhere to be able to continue building. But, for the likes of Celsius and BlockFi, it looks like majority of their capital has been, somewhat, like I said, they received the credit line. So, I do think that they're going to be just fine. And they're the ones that were, I would say, probably at the position to cause the biggest downside cascading risk to the price of the market. And so because they have been saved, I think the major problems have been relinquished a little bit. It's just, like I said, it's just a lot of the smaller players in the space that probably are not going to get bailed out, which is unfortunate, that are going to be hurting for, I would say, the next, 6 months.
Cool. That's very helpful. Very helpful. And, we'll go ahead and switch gears away from the FUD a little bit and kind of turn a little bit more positive, a little bit more informational for the community, and kind of help them understand what they can do to kind of become better investors, just better people in the space. So maybe talk a little bit about what you guys pay attention to from a metrics perspective, whether that's a crypto metric, whether that's a TradFi real world metric. Obviously, like, interest rates are really impactful to you guys, as well as just, I guess markets in general. But maybe talk a little bit about, like, what are the metrics that you really focus on to not only just understand how it may impact your business today and tomorrow, but just like where you want to go as a business and as a protocol. Teddy, you want to kick it off?
Yeah, sure. So I think probably the number one metric. I mean, there's some like easy shorthand ones like TVL and sort of total loan volume. I think that what we want to see more of is the ability to generate yield via Notional. So like the thing that we're kind of most focused on is increasing sort of like open borrowed amounts, right? And I guess because my feeling is that I think what we've seen is that if the yields are there, like getting capital in is really not so much of a problem. Now, like multiplying the amount of capital in DeFi by like 10 or 100x, like it wouldn't be easy. But like if there's money to be made, if the yield is there, like getting the capital in is not really the problem. I think that like what we're looking for is the thing to look for is just like how can you generate those returns in DeFi, and then how can you like package those returns such that there's like an easy way to like for outside capital to invest in them, right? And I think that's like the most important thing is like how like capable is the DeFi space at like generating returns, right? In one way or another, right? Whether it's people borrowing against their crypto, just plain vanilla, or if it's like trading fees on DEXs, or it's like just, credit, like DAOs actually wanting to borrow money to like finance their operations, right? That's all like different ways to generate that like DeFi as a system generates returns for people who have capital. And what I think for DeFi to grow, it's really like that is what has to grow. It's not like, the capital is going to come in first and wait around, right? It's that like the DeFi system as a whole just starts making more money. right? And like that's like the really important thing, because again, I think it's a lot easier to get the capital in when the returns are good. Yeah.
What's your take, Windra?
For my take, I think one of some of the more important metrics that we pay attention to and I think about a lot is just the abstraction of risk from these DeFi protocols in general. I think because everything is so new, the outside looking in to participate with these protocols is that it carries a high level of risk, whether that's direct risk, compounding layer risk, of different various protocols that are being utilized. There's default, there's DPEG risk from various stablecoins. So I think through the test of time, of course, through these different incidents that happen in the market that really affects how crypto is behaving, I think as time goes by and as the level of risk goes down, more and more people are willing to participate. I've had conversations with family offices from Taiwan, for example. These are like some of the most conservative people who've done real estate for 20, 25 years and they generated 8% average return. And their perspective is if they can get 8% guaranteed per year doing exactly what they've been doing for the past 25 years, what's the incentive for them to participate in DeFi when they are exposing them to all these unknown risks in a space that they're not familiar with? And I think that eventually we'll get to a point where those risks are no longer an issue and we can get competitive rates, 5 to 8%. And it will be a place and a platform where a lot of these conservative users can come in and participate. So a metric that I look into is just how we tackle some of those external risks one by one. And it's such a different space now than it was a year and a half, 2 years ago. A lot of these mature protocols have started to really tackle a lot of these risks and eliminate them. And so I think we're headed in the right direction.
How about you, Gabor? What are you paying close attention to?
Yeah, a bit of everything that Teddy and Windra said, and yeah, maybe just an anecdote. It's funny what you said that the family office of experience and track record of 8%. Like, why would they engage with crypto? We have had the same conversations with some other professional investors or family offices, and I think these people they don't get the point, and you can't generalize that crypto is per se more risky than, say, real estate. If you engage with rather safe protocols like Notional or Aave, like why would you say that this is more risky? Of course, there's some oracle risk. There was this one exploit surface that was uncovered on Aave on the L2s, but still, like, these protocols, I would rather put my money there than in some emerging market real estate, to be frank. So education is very important, and I think we are all putting our strings to educate people that and crypto is just perhaps a different and more efficient infrastructure where you can potentially get a decent yield and probably with a good risk reward. It's interesting that when someone promises 20 or 30% APY in a stable coin, that everyone throws his money on it. But if someone gives a stable yield of 6%, people are rather turned off. It should be vice versa. Maybe this is where we are heading right now, is that people get back to a healthy risk reward expectation, and you should rather doubt that someone promises you 30%. But we were upside down on that one. The metrics we're looking at now, focusing on Maple, or I personally being responsible for the risk, is actually the probability of default and the expected credit loss. And given that we are staking a pool cover tranche, this is the first loss piece, we are super focused on keeping a clean sheet, because if we have a default and a loss, we are the ones that are taking a full hit. So not having a loss is our utmost focus. Less TVL. TVL is a important metric for all protocols. It is a bit used for signaling and the success. But now is the time where we want to be sure that the protocol works as intended and that the funds are safe and that the asset class is not only working in sunny times, but also when it rains, and that the risk reward that we have promised at some point a year ago is actually accurate, or maybe even proves that is even better than what we thought. So TVL may go down now. I understand if people are worried about or just want to pull funds together just to be on the sideline, or even YOLO all in because the prices are low. So we have also had people withdrawing funds because they want to market buy. I understand that. So TVL is a bit less of a focus. Of course, we want to grow long term, but in the short term, it's really about proving that we all do a good job, and I think this is the case for all protocols right now.
Got it. That's all really great insight, all. And one thing I guess to say is I know Teddy needs to run. I know he has a hard cutoff. So just wanted to thank you, Teddy, for stopping by and maybe give you the opportunity to have any final words. But if you have to run, that's fine too.
Yeah, thanks a lot for having me. I think we're all building something really valuable here, and again, past few weeks I think have made that more clear than ever. So again, thanks for having me, Matt, and see you guys all later.
Thanks, Teddy. Really appreciate it. And Gabor, Wendra, hope you guys can stick around. If you have to leave, feel free. But one thing I wanted to unpackage was we keep talking about the interest rates we've seen, some that are obviously under ones that are just not sustainable, right? We talked about the anchor situation. We've seen other situations where it's just a very, very unsustainable high yields that we know will never going to last in perpetuity. So I wanted to kind of dive into a little bit deeper about what we might see with rates long term. I think we have seen a pretty large delta between DeFi rates and TradFi rates. And so obviously there's a lot of attributes and criteria and variables that are causing that, but maybe talk a little bit about, pull your crystal ball out. What do you guys see about that delta between DeFi and TradFi rates long term? Do you think we'll kind of minimize those as much as possible, or is this going to be a situation where DeFi is going to win no matter what, and TradFi won't really have any rates to offer? But just any insight on where you see that delta ending up long term?
Yeah, very happy to start on that, and then Windra can give his view. But ultimately, it comes down to supply and demand. And pre the crash, we have seen an oversupply of capital on the CeFi side, and this has led to a lot of pressure. They had to get the money out to fulfill the promises they made towards their depositors. And on DeFi, with this deliberate opt-in, and if the yield is not juicy, it's very mercenary capital. You just shuffle around. So DeFi clearly had the disadvantage on the funding side. Now this has pivoted. Currently, we observe many cancellations from CeFi, given that they need to serve withdrawal requests as well. And there's a lot of liquidity leaving the system, which is actually a great opportunity for DeFi. So with the addressed market by us, i.e. crypto native borrowers, there has been limited loan issuance, but we know that the rate has leaped from, say, a range of 7 to 8.5%, 9% to clearly double-digit, 12 to 15% even right now. The volatility creates ample opportunities to run highly profitable market-making algorithms, and what is scarce right now is capital. So currently, I think it's actually a pretty attractive time to provide credit. This is actually the time when you should do it. In the medium term, this will, I think, reverse a bit. With the safety lines that FTX provides, this should bring some more security to the CeFi side, and they will re-enter the space, I guess, but perhaps a bit more cautious. So there was a clear lack of proper credit standards. I'm not saying that they all did a bad job, but it was just too loose. It was like the 8 times leverage structures ahead of the financial crisis, and it was the same here, that the credit standards, they should be a bit better, and they weren't. And I hope that just the whole space emerges as a bit more professional, hopefully way more professional. So in the long run, this is really crystal ball game, but I think the rates should be more close to each other. If one of the both camps is cheaper for borrowers, the borrowers will opt for the cheaper one. There's very little justification to pay a premium. Like one premium reason could be the track record that you build on chain. If you have lending activity there, it's registered how much loans you've taken, that you always paid in time the interest, you returned your capital or your loan in time. So there is a benefit. So there's a reason to pay a bit of premium, but you don't do a 3-4% premium. So they should align again. But in the short, medium term, I think DeFi has a great opportunity to have better yields than CeFi.
What are your thoughts, Wendra?
Yeah, I do think that the maturity of the market is going to cause these interest rates and these yields to converge. If you look at, getting a collateralized loan on something like Chase Bank at the moment, I think it's like they're offering like a 2% rate. And if you want to get like a credit loan on Chase or Wells Fargo, it's 8%, depending on your credit. But those seem to be similar numbers to what we see in DeFi. And the difference is that, when you pay 8%, that 8% goes to Wells Fargo, even though the users that are depositing into their savings account is the ones providing the capital. But in DeFi, it's different. It's the users that are actually providing the capital that are getting the 8%. I think that the big difference here is, I think, on the structured product side. I did capital markets in 2018, and I worked with a few brokers who traded structured products, and those brokers take a huge cut on the fees that are generated from the profits gained on those structured products. And the difference between CeFi and DeFi is that when you create and compose on DeFi primitives, everything is on chain, and you can see exactly how that product is. Therefore, it gives anybody a competitive advantage to be able to undercut somebody else who was effectively taking cut from the user. If product A is offering a 5% yield, and kind of look under the hood and realize that 3 different parts cut from that DeFi structured product, you begin to somebody else can reconstruct that product and start over, effectively offer a better product and a higher rate to the users that are interested in buying those products. And I think that's the competitive advantage that DeFi has, taking that aspect of transparency to always be able to offer great yields to the user in comparison to what they are accustomed to seeing in traditional finance, because I've seen structured products take, 10-15% for a basic principal protected. And so, I hope, not to see that in DeFi, of course, but I do think that's one of the competitive advantages that DeFi has in terms of characteristics in regards to the yields.
100%.
Yeah, I think based on all the things that you guys said, as well as some things that maybe have been gone unsaid, really about how capital efficient DeFi is, the transparency of everything, the forkability of it, and how people always have to stay, maximally competitive, definitely give DeFi an edge. And, I don't really see many situations where TradFi ends up winning in the end. But, with us kind of running out time, I know we talked a little bit about FUD. We talked about some of the major things that you guys are keeping an eye on. Leave us inspired. What do you guys see as the end game of DeFi? Like if you look, 10 to 20 years, even though that's hopefully not the end game for what we're building here, but if we just kind of look at that time horizon, where do you think DeFi is operating at? What does it look like at that point in time? Wendra, you want to kick it off?
Yeah, I do think that, in 10, 15, 20 years time, DeFi is going to be just called finance. I think this is where everything is headed in terms of financial product construction. I think that DeFi primitives, because they're well built to survive a lot of things that, centralized finance platforms are not built to be able to survive. I think someone mentioned earlier that when the crash happened in 2008, the New York Stock Exchange had to down and things had to unravel a lot and nobody knew what was happening behind the scenes. And that's not necessarily the case in regards to DeFi, I think if we can survive things like this, I think it's really, really important to kind of pay attention to, what comes out of all of this in the next year or so, because those are going to be, the players that are going to be surviving and thriving long term, and can't wait to see some of the new iterations of these products and protocols get built out, because I think that this is where the future of finance is.
Yeah, fully share this vision, and I guess like most people here on this call are already using DeFi as Fi, I would say. So probably receive salaries in USDC streamed through protocols, use DeFi for saving, use DeFi for lending. So I guess the infrastructure even today is already pretty impressive and fulfills many of the basic financial functions. And from here, we just need to continue build, make it more sophisticated, make it more secure, less attackable, less exploitable, more efficient. I mean, we are all pretty much believers in this. So in this panel, there was no TradFi voice, and I guess it's pretty hard to argue against all the merit that DeFi brings. So it's just about getting more people on board, educating, and showing the power of it, and then people will join, and it's becoming a bigger movement. And I also think that DeFi will become Fi ultimately.
Well, I'm definitely excited for that. I have 2 young kids, and I really hope that they grow up in a world where maybe DeFi is not a term unless it's in the history books, and it's just, as you guys put it, just finance, and it's all in the blockchain. I think that'll be, a better world really for everybody. And so really appreciate you guys coming out. I know we have some house cleaning items, some updates on our end. So wanted to kind of reserve some time for that, but wanted to kind of give you guys some final word. Did you guys have anything you wanted to kind of leave us with? Anything that we should be kind of aware of as we kind of leave this conversation?
Yeah, thanks for having me here. Really enjoyed the conversations and the questions. If anybody's in New York, I'm going to be judging ETH NYC throughout the weekend. Just come say hello. We'd love to talk to you all about everything. So anything related to DeFi or anything in general. Just thanks again for having me.
Yeah, likewise. Also, thanks for having Sid and me. Very happy to come back at any time when there's a similar panel to give some insight into what's happening in the lending side. And I'm a bit sad that people stopped saying "work me," so I'll end with this. Work me.
I like it. Well, again, really appreciate you guys both coming out. We'll definitely continue the conversations together, and you'll see how we can kind of deepen our relationships. But it's been really awesome hearing your perspectives, and again, like similarly, all these kind of these panel calls and these conversations, I'm definitely leaving a better informed investor and just a better all around crypto native. So I really appreciate you guys coming out.